Hello everyone, hi, welcome to the channel of Wall Street Mojo. Friends, today we are going to learn a tutorial on tax shields. We'll be learning few formulas in this regard. There'll be some examples and definitions and some calculations. So let's get into the nitty-gritty of the same. At the very inception, tax shield is basically savings in the taxable income for the corporations or individuals by deducting the allowable expense like such as interest, depreciation, hospital expenses, etc. So tax shield has become a very important part of decision making process in project finance and corporate finance. So in this article we are going to look tax shield in complete detail. So first let's get into what is tax shield. That is the first and the foremost thing. If we talk about tax shield is basically a reduction in the, or I'm just writing in negative, that reduction in the tax income. Okay, it will be reduction in the taxable income for the individuals or for the corporations, and achieving through the claiming allowable deductions such as interest, like medical expenditures, charitable donations, amortizations, and depreciations. See, the income reduce taxpayers taxable income for a given year or defer income taxes into future periods. So it is a way to save, you can say, cash flows and increase in the value of the firm. Increase in the value of the firm. Now, the tax shield strategy can be used basically to, you can say, increase in the value of the business and increase in the value of business. And since it reduces the tax liability that would otherwise reduce the value of the entity's assets. Now, tax shield is basically path to save, you can say, cash outflow and appreciate the value of the firm. So tax shields in a way of various forms involve in types of expenditures that is deductible from the taxable income. In simple words, you can say a tax shield is PV, or the present value of future tax savings attributes to the tax deductibility of the particular expenditure in the profit and loss account. Now let's understand some of the importance of, benefits of the tax shield, that is the importance of the tax shield. See, tax shield lowers the tax bills, which is one of the major reason why taxpayers, whether individual corporations, spend considerable amount of time determining which deduction and credits they qualify for each. So there are some of the benefits of the tax shield. Let's understand each one by one. Benefits of tax shield. The first is tax shield, there are some of the cases where tax shield can be taken, in case of depreciation. Tax shield can be taken in case of interest. Tax shield can be taken in case of individuals, and so on and so forth. So second and third. Now tax shield on depreciation, if we talk about, tax shield on depreciation is proper management of assets for saving the tax. A depreciation tax shield is basically a tax reduction technique under which depreciation expense is subtracted from the taxable income. And this is basically non-cash item, but we get deduction from the taxable income, and this will become a major source of the cash inflow, which we save by not giving the tax on the depreciation amount. It's just like provision we create every year in respect of the capital expenditure, and so on and so forth. Let's understand this with an example. Now let's say there is a company which has investment proposal in a project involves a capital outlay of close enough to 90 million in a plant and machinery. The project would have a life of how much? 5 years, at the end of which the plant and machinery could fetch close enough to value of 30 million. So that is the salvage value, you can say. Further, the project would also need a working capital of 1,25,000, which would be built during the year 1 and to be released from the project at the year end of 5. So working capital is, this is just like capital budgeting based illustration. The project is expected to yield the following cash profits. Let's see what exactly is there in our arena. As you can see, the cash profits which are given 35, 30, 25, 20, and so on and so forth. A 25% depreciation for plant and machinery is available, and the corporate tax is paid in 1 year in arrears, which it relates to the first year, and would be claimed against the profit of the year 1. Now over here there are some other details, like the management accountant has calculated the NPV and the corporate target is 20% pre-tax return. The corporate tax is expected to be 35% during the life of the project, and thus the company's rate of return post is 20%, that is the target return, into 65%, that is the post-tax value, that is 13% is the post-tax return. What are we told to do? To calculate the post-tax cash flow at the post-tax rate, which is very important. Post-tax cash flows at post-tax rate, pre-tax cash flows at pre-tax rate, as simple as that. So calculate the NPV of the project taking the tax shield formula into consideration. So let's get into the nitty-gritty of the same and see what exactly the calculation is there right in front of us. If we go down and see, we have a couple of details regarding year 1, year of the profit, the cash profits that we had in our table, the tax on this profits, and the year of tax payment that will be in year 2. So this will be paid in year 2, 3, 4, and so on and so forth. It will be succeeding year. Now depreciation allowance on the same. Now we start with year 0, 1, 2, 3, 4. On the basis of reducing balance method, that is WDV, the depreciation has been calculated on which the tax rebate is taken. So on this depreciation, if you multiply the tax rate, you get what? The tax rebate, that is called as the tax shield, and that will be available in the following years as it has been mentioned, like 2, 3, 4, and 5, and so on and so forth. So if you go down, you see the profit on the sale of the plant and machinery is 30,000 less 21.537. Now just come down more. Once you do that, you have your investment, working capital that you had invested, then the depreciation details that you just found, allowance, that is basically the tax saving on the debt, and that is basically your savings, the cash profits, the tax on the profits, and that is why it is in negative. The net cash flows is going to be your total plus all the savings that you make, and then you discount that with the relevant discounting factor, that is 13% over here, and then finally you get the present value. So once you do that, you get the final net present value, and the net present value over here in this case is 1.57. Now let's start with tax shield on the interest. See, interest shield in case of the company or corporation, one of the major important objective of the corporation or the firm or organization is basically nothing but to reduce its tax liability. Very important, for which he has to compute the tax shield, or we call as tax advantage, and computing the interest tax shield, right? So now let's understand the valuation of the interest tax shield. See, first what you need to do in this particular case is you need to capitalize, or you can say recapitalize, you can say recap the value of the firm, and the second is limits on the tax benefit of the debt. Now interest expense is basically, you can say, is opposed to dividend and capital gain tax deductible. Therefore, the tax shield is important factor. There are tax benefits derived from creative, and as we know that the value of the interest tax shield is basically the present value of all the future interest tax shields. Also the value of the levered firm of or organization exceeds the value, or else equal unlevered firm or organized by the value of the firm interest tax shields. So lease options is one of the live example for utilization of the tax shield. Now let's understand interest tax shield calculation with an example. In this example, if you see, ABC Limited is considering a proposal to acquire a machine costing of 1,10,000, which is payable at 10,000 down payment and balance in 10 equal monthly installments. So it is basically on lease, you can say, finance lease at the end of each year, inclusive of interest chargeable at 15%. Another option before it is to acquire assets on lease rental is 25,000 per annum payable at the end of each year for 10 years. So this is basically your operating lease. The above was your finance lease. The information related to the same is present value factor interest rate is 15% for 10 years, and we have been given the present value factor, which is 5.019, the terminal scrap value, which is 20,000, which is realizable if the asset is purchased, and the company provides 10% as depreciation. Income tax is 50%. What you are required to do is you need to compute and analyze the cash flow and advise to which option is better. First, option 1 is to be. So over here what you are doing is you are basically getting into a finance lease. In this option you pay 10,000 as down payment, balance 1 lakh in the at an interest rate of 15% in 10 equal installments, and the amount of the annuity will be calculated as the 1 lakh amount divided by the present value factor that has been found out over here, which is 5.019. Now this is your annual repayment, that is 19925. Now what we have seen is, what over here is annual repayment, that is the EMI, you can say. The discounting rate, it is called as WACC. Why we use WACC? WACC is the complete cost of the company, that includes the cost of equity, cost of preference shares, cost of debt, and so on and so forth. So over here we use the same rate for leasing and borrowing option, and there will be no change in the final decision. The answer may vary. Now the depreciation was 10%, as we know, so on the amount of the total asset, which is 1 lakh 10 into 10%, has been provided for all the years. The asset is fully depreciated during the life of 10 years, and therefore the book value at the end will be 0. That is quite logical. Salvage, which is given to us, is 20,000, and that would be your capital gain, because 20,000 minus 0 is your capital gain, presuming that taxable at the normal rate of 50% of the net cash inflow on account of salvage value would be 10,000 only. That is 20,000 is your salvage value into the 50% as the normal rate. So the cash flow for the same is, if you go down and see here, the installments, the interest rate, and the repayment that you do is installment minus interest, that is repayment, and the balance details. So that is basically your complete table regarding the repayment. When you come down, you see that there's a payment, interest, depreciation, there's a tax shield. Tax shield will be on 3 plus 4, that is your interest and depreciation, and the net cash flow will be your payment less the tax shield, because tax shield is your gain, and you will multiply with the present value factor to do the present value. Now the second option was leasing, that is finally the leasing on, in case if the asset is acquired on annual lease, the rent to be paid is 25,000 payable. Over here the net present value is 51,336 after inputting all the details. This lease rental is tax deductible, as we know very well. 25,000 into 50%, that is 12,500. So present value factor of 10 years at the rate of 15% is already that we know 5.019. So this 12,500 into, for the present value factor for 10 years, which is 5.019, that gives us 62,738. So by comparing the above two option, what we get is the present value of, in case of buying the tax shield, is lower, as it is 51,336, compared to the one that is the operating lease sort of, that is 62,738. So based on this example, we can make final conclusion that what we need is to be understood is tax shield is very important aspect of the business valuation, and it vary from country to country, and the benefit depends upon the taxpayer's overall tax rate and cash flow for the given tax years. So government often create tax shield as a way to encourage certain behavior or investment in certain industry or programs. Thank you everyone.